Okay, sorry for the unexpected scenario. This video is just to correct our misleading information in our video group presentation. So for pool OLS, fixed effect and random effect, we first differentiating our variable. For pool OLS, R square is really weak, which is only 21.78% variation in GDP can be explained by independent variable. For fixed effect model, LGFC show significant but negative impact. R square very strong, which is 99.77% variation in GDP can be explained by our independent variable. For random effect model, LGFC also show significant but negative impact. R square is weak, which is only 44.65% variation in GDP can be explained by independent variable. And these three methods show autocorrelation, which is during Western test results show further than 2. For GMM part, gross fixed capital or LGFC and unemployment or LU are not statistically significant and negative impact, suggesting that in the short run, investment and labor market changes have limited impact on GDP growth in this model. Overall, the GMM estimation is valid and the result emphasizes the role of human capital in promoting economic development. So that's all for the correct information from our group presentation. So I hope you enjoy the next video, which is our video presentation. Thank you.
Terima asal ada nona bicara. Stay true, telan cuek baru malu.
Everyone, today we are presenting our Econometrics research project titled Human Capital and GDP Growth. The main objective is to examine how human capital affects the economic growth using various panel data econometrics technique that gather from 9 Asian countries. We use data from the World Bank with the dependent variable GDP, independent variable human capital, or we call it as HC, gross fixed capital formation GFC, and also unemployment, which is U. We apply pool OLS, fixed effects, random effects, and last but not least, GMM or generalized methods of moment estimators.
Stay true, telan cuek baru malu.
We explored the distributive statistics and decided to log transform all variables like GDP, human capital, capital formation, and unemployment. This transformation helps in stabilizing variance, interpreting coefficients as elasticities, and making comparisons easier across countries and over time. This is particularly useful for economic data where variables can have skewed distributions. This slide presents the descriptive statistics of our 4 key variables: LGDP, log of GDP, LHC, log of human capital, LGFC, log of gross fixed capital formation, and LU, log of unemployment. First, all variables have 171 observations, ensuring a balanced panel. LGDP has a mean of 30.49 and a relatively high standard deviation of 3.96. reflecting significant variation in economic size across countries. LHC and LGFC are more stable, which means around 3.3 and lower standard deviations. Unemployment, LU, has the smallest mean 0.79 but the largest standard deviation of 0.99, indicating wide disparities in unemployment rates. Looking at normality, based on the Jacobera test, GDP, LHC and LGFC are approximately normally distributed with p-values above 0.05. However, LU significantly violates normality with a Jacobera p-value close to 0.000, and it is also negatively skewed, meaning many countries have low unemployment but a few have a high extremes. Overall, this summary supports our decision to log transform the variables for consistent scaling and easy interpretation, and it highlights the need for robust models to account for variation and normality, especially in unemployment.
Stay true, telan cuek baru malu.
tested for stationary using the augmented decoupled ADF test. All variables LGDP, LHC, LGFC and LU were non-stationary at level but became stationary at first difference with p-values below 0.01. This ensures we avoid spurious regressions and confirms we can proceed with panel regression models using reference data.
Stay tuned, telan cuek baru malu.
Next, we talk about the Pagoni cointegration test. When the variables are in first difference, the Pagoni cointegration test shows a long-term equilibrium relationship between GDP and independent variables. The ADF statistic gave a p-value of 0.0000, confirming that GDP, human capital, capital formation, and unemployment are co-integrated.
Stay tuned, telan cuek baru malu.
First, we estimated the model using pool OLS. This method assumes no unobserved individual heterogeneity, meaning it treats all countries as if they are homogeneous. Human capital, LHC, showed a positive and significant relationship with GDP. As expected, growth fixed capital formation, LGFC, also showed a strong and positive effect, indicating that physical investment contributes to the economic output. Unemployment, LU, had a negative and significant coefficient, meaning higher unemployment reduced GDP. While intuitive, this model doesn't account for country-specific effects, which may bias results.
Stay tuned, telan cuek baru malu.
We use the fixed effects model, which control for the country's specific characteristics that do not vary over time. LH remain positively significant, reinforcing the even after controlling for the individual heterogeneity. Human capital improved the GDP. LGFC continued to show a positive effect through slightly smaller than in a pooled OLS, possible due to the environment control. LU still showed a negative effect, suggesting that persistent unemployment weakens national output. This model is better suited that the pooled OLS when unobserved country reflect the important.
Stay tuned, telan cuek baru malu.
Then, we apply the random effect model, which assume that country-specific effects are random and uncorrelated with regression. Human capital remain positive and highly significant, validating its role in long-run growth. Gross fixed capital again have a positive and significant impact, suggesting physical investment boosts productivity. Unemployment continue to exert a negative and statistically significant effect on GDP. This model is more efficient if the assumption holds, which we tested.
Stay tuned, telan cuek baru malu.
Choose between model for branch Megat LM test. If significant or P less than 0.05, we reject pools OLS in favor of our REM. Hasniezam test, if P more than 0.05, REM is preferred. If P less than 0.05, FEM is preferred. Although the Hasniezam test suggests random effect is appropriate, we also estimate the fixed effect model to confirm the Razdan of our result. The similarity in confirmation across both FEM and REM strengthens confidence in our findings. Thus, we rely on REM as the preferred model, supported by theory and robustness check. Thank you.
Stay tuned, telan cuek baru malu.
Guys, this method do not cover the indigeneity. Oh, really?
We have ENN endogenous, especially since human capital may be endogenous due to reverse causality or omitted variable. We use DMM estimation. The DMM results show that human capital remains a significant and positive driver of GDP growth, even after correcting for endogeneity. Capital formation or capital fixed information is also significant and positive, confirming that investment in infrastructure and machinery lead to economic expansion. Unemployment is again negative and significant, showing consistent results across models. This confirms the robustness of its impact and supports the idea that higher investment in education and workforce skill leads to higher productivity and growth. We also test for AR test. The AR1 test is usually rejected as expected, and our result also show rejected. Importantly, the AR2 p-value is greater than 0.05, indicating no second order serial correlation. This means our instruments are valid and the GMM model is reliable.
We get it!
Stay true, jalan cuek baru malu.
Next, we'll talk about integration and policy. Let's summarize. Firstly, we have human capital. In all models, higher human capital such as education, skills and health leads to higher GDP. Governments must invest in lifelong learning, TVET and health services. Next, we have gross fixed capital formation. A consistently positive impact shows the importance of infrastructure and machinery. Public and private investment must be encouraged. And lastly, we have unemployment. The negative relationship is strong and consistent, highlighting the need for policies that reduce joblessness, especially among youth. These findings support a comprehensive political to develop both human and physical capital while reducing labour market frictions.
Stay true, jalan cuek baru malu.
In conclusion, our econometric analysis confirms the long-run significance of human capital investment, and employment condition in driving GDP growth.
Using full OLS, FEM, REF and GMM, we validated the robustness of our models.
Our findings are statistically sound and economically meaningful.
Therefore, policymakers should prioritize investment in education, infrastructure and employment generation to foster inclusive and sustainable growth. And that's all for our group. 1, 2, 3. Untuknya bumi masih berputar. Untungnya bumi tak menyerah. Hey, 1, 2, 3, legit.
Di kesempatan ini, kami ingin mengucapkan terima kasih buat pensyarah kami, Madam Aiza Liyana yang telah banyak membantu dan mendidik kami untuk subjek Econometrics 1 dan 2. Walaupun Madam telah menghadapi pelbagai cabaran dan rintangan, Madam masih kuat untuk mengajar kami. Kami mendoakan Madam sentiasa dipermudahkan segala urusan dan menjadi lebih kuat. Diharapkan Madam dapat mengajar kami di subjek yang seterusnya. Thank you very much, Madam.